The fixed asset turnover ratio is an important financial metric used to evaluate how efficiently a company uses its fixed assets to generate revenue. Fixed assets are long-term assets such as property, plant, and equipment that are not easily converted into cash. This ratio measures the revenue generated per unit of fixed assets, helping to assess the effectiveness of asset utilization. Fixed asset turnover ratio. The fixed asset turnover ratio is used to determine how well a company is leveraging its fixed assets to produce sales. Unlike other efficiency ratios, which might focus on overall asset management or inventory control, this ratio specifically targets the use of fixed assets. It provides insight into whether the company is using its physical assets efficiently to generate revenue. To calculate the fixed asset turnover ratio, divide the company's total revenue by its average net fixed assets. To break it down. 1. Determine the total revenue for the period, which is the total income generated from sales and other operations. 2. Find the average net fixed assets for the same period. Net fixed assets are calculated by subtracting accumulated depreciation from the gross fixed assets. The average is typically found by adding the beginning and ending net fixed assets for the period and dividing by 2. Example. Consider a manufacturing company that has $2 million in annual revenue. At the beginning of the year, its net fixed assets were $800,000, and at the end of the year, they were $1 million. To find the average net fixed assets, add the beginning and ending values, $800,000 plus $1 million, and divide by 2, which gives $900,000. The fixed asset turnover ratio is then calculated by dividing the revenue by the average net fixed assets, $2 million slash $900,000, resulting in approximately 2.22. This indicates that the company generates $2.22 in sales for every dollar invested in fixed assets. Low fixed asset turnover ratio. A low fixed asset turnover ratio suggests that a company is not using its fixed assets efficiently to generate revenue. This might indicate overinvestment in fixed assets, underutilization of existing assets, or declining sales performance. For instance, if the ratio is significantly below industry averages, it may signal that the company has excess capacity or outdated equipment. High fixed asset turnover ratio. A high fixed asset turnover ratio, on the other hand, indicates efficient use of fixed assets to generate sales. It suggests that the company is making good use of its physical assets to produce revenue. However, an excessively high ratio could also imply that the company might be operating its assets at or near full capacity, which could lead to potential strain on equipment or future growth limitations. How can companies optimize fixed asset turnover ratio? Increase revenue without expanding fixed assets. Focus on boosting sales through improved marketing, product development, or market expansion while keeping fixed asset investments steady. Improve asset utilization. Regularly review and maintain fixed assets to ensure they are operating efficiently and are fully utilized. This includes upgrading outdated equipment and optimizing asset management practices. Streamline asset acquisition. Be strategic in acquiring new fixed assets. Ensure that new purchases are necessary and will contribute significantly to revenue generation. Key takeaways. The fixed asset turnover ratio is crucial for evaluating how effectively a company uses its fixed assets to drive sales. By understanding this ratio, businesses can gain insights into asset management efficiency and make informed decisions. The ratio measures revenue generated per unit of fixed assets. A low ratio may indicate inefficient asset use or declining performance, while a high ratio suggests effective asset utilization. To optimize the ratio, companies should focus on increasing revenue, improving asset utilization, and being strategic about asset acquisitions.